He signed my name on a loan for $200,000. Then he sat across from me at our weekly operations meeting and talked about Q3 vendor projections. He did not flinch. He did not hesitate. He just sat there, in the chair across from mine, reviewing the same logistics spreadsheet we had been using for 3 years, and he talked. I did not know yet. That is the part that stays with me. For 3 weeks after he signed my name, I sat in the same room as him twice a week. I answered his calls. I approved his expense reports. I forwarded his vendor invoices to accounting. I had absolutely no idea what he had done. By the time I found out, the bank had already sent the first late notice to my address, in my name, for a debt I never agreed to, never signed for, and never touched a single dollar of. This is what I did next. What you are about to hear is not a story about losing everything. It is a story about what happens when someone underestimates how carefully you have been keeping records, and how much those records are worth when everything you built together suddenly becomes evidence. I am going to walk you through a business partnership I built over 6 years, a betrayal that took 14 months to fully untangle, and a single document request that shifted the entire case in a direction he never anticipated. By the end of this video, you will understand exactly how the bank that called me to collect on a forged debt became the same institution that handed federal prosecutors everything they needed to build a 7-count indictment. Before I tell you what I found on page 4 of the bank's internal audit file, and I will get there, I need to tell you what my business actually was. Because the business is the reason any of this worked. I ran an event production company, not a large operation, but a precise one. 12 full-time staff at our peak, 30 or so contractors depending on the season. We produced corporate events, product launches, nonprofit galas, and a significant and steady volume of high-end private events, primarily weddings. The weddings were our most consistent revenue source, and they were the work I was most protective of. A client who has spent 18 months planning a wedding does not negotiate on production quality. She is the one calling at 11 at night about the positioning of candles on a long table. She is the one sending 47 emails about the difference between ivory and warm white linen. And when her wedding night is exactly what she imagined when she walks into the room, and everything is correct, she tells every person she knows who made it happen. Our entire business ran on that referral network. We had built a reputation over 9 years for being the company that did not miss details, that did not cut corners under deadline pressure, that did not send an invoice without delivering exactly what we had promised. That reputation was not an abstraction. It was the only real asset the company had, and I protected it accordingly. My business partner came into the company in year 3. We had met through a mutual client. She had used us for 2 consecutive product launches and recommended him as someone who could take the operational load off me so I could focus on client relationships and creative direction. He had a background in logistics and vendor management. The arrangement made sense on paper, and it worked cleanly in practice. He handled procurement, supplier contracts, and the back end of production logistics. I handled client accounts, creative oversight, and financial approvals. That last part matters. Financial approvals were mine. Every vendor payment above $500 required my sign-off. That structure was in the operating agreement we both signed in year 3. It was not informal. It was documented, acknowledged, and built into every process we ran. For the first 3 years of the partnership, everything operated exactly as it should have. Then the quarterly reconciliations started showing numbers I could not account for. The first time I noticed it, it was in a routine expense review. A vendor invoice appeared in the expense column that I had not approved. $2,200 to a supplier I did not recognize. When I flagged it, the explanation was immediate. An emergency equipment rental on a weekend when I had been on site at a venue and unreachable for several hours. The explanation was credible. The amount was below the threshold that would have triggered a formal audit. I accepted the explanation and moved on. That was the first one I remember. It was not the first one he had run. Over the following 8 months, I noticed 7 more. Always reasonable explanations. Always amounts that fell just inside the range, where I might flag something but would not escalate it. Always tied to circumstances that were just busy enough or just complicated enough that pressing further felt like it would slow down a production schedule we were already running hard. I moved on each time. I want to be honest about that. I want to pause here because I know what is going through some of your minds right now. You are thinking, how do you not catch this? How do you run a detail business and not see it? I have sat with that question for a long time. The answer is not that I was careless or that I was not paying attention. The answer is that I was managing an active company with 50 events per year, that I had a documented partnership structure built on a clear division of responsibilities, and that 6 years of working alongside someone creates a familiarity that functions like a blind spot. You stop verifying the small things because the small things have been correct for long enough that you have stopped expecting them to be wrong. That blind spot is not a character flaw. It is a vulnerability, and it is exactly the kind of vulnerability that someone patient and methodical will find and use if they are looking for one. Keep that in mind. We will come back to it. The loan notice arrived on a Tuesday. I remember the morning specifically. I had gotten in early because I was prepping site diagrams for a Friday gala, and the venue had sent a floor plan revision the night before. I was at my desk with a second coffee before 8. The mail was already on my desk from the previous afternoon. The notice was in a standard bank envelope, addressed formally to me. Full legal name. Business address. A reference number for a commercial credit account I had never seen in my life. The letter stated that a payment of $4,200 was 31 days past, due on a $200,000 business line of credit. I read the letter twice. Then I set it down and picked it back up and read it a third time. Then I called the bank. The loan officer I reached was professional and patient. She pulled the account number from the letter. She told me the account had been opened 11 months earlier under my name and my company's federal tax identification number. She confirmed that the address on the application was our business address. She told me the account was a business line of credit and that draws had been made against it regularly over the 11-month period. She asked me to verify the signature on file for the account authorization. I asked her to describe it to me rather than confirm it. She read the description. The name was mine. The signature was not mine. I told her that clearly, calmly, and without any softening. I had never applied for this line of credit. I had never executed any document associated with this account. I had never drawn on it, authorized a draw on it, or received any communication about it until the late notice I was holding. I needed to know everything about how this account had been opened in my name. She transferred me to the fraud division. That call lasted 2 hours and 40 minutes. By the time I hung up, I had 3 facts I did not have when I walked in that morning. The loan application had been submitted online through the bank's commercial lending portal. The application package had included a scanned signature page on the credit authorization form that appeared to carry my signature. And of the $200,000 drawn down over 11 months, $194,000 had been transferred out of the account in a series of wire transactions to 3 separate destination accounts. I already knew whose name was going to be on those accounts. The bank's initial position was professional, but not reassuring. The fraud division was systematic, and they took detailed notes. But the legal language their team used made one thing completely clear. Until their investigation concluded, I remained the named borrower of record on this account. The debt was in my name. The late reporting to credit bureaus had already begun, and if the investigation produced any indication that I had been aware of the loan, had benefited from any portion of it, or had authorized it in any form and was now disputing it after the fact, the legal exposure for me would be severe. My attorney reviewed the bank's position and gave me her honest assessment. Settling was the faster path. The litigation timeline on a contested bank fraud investigation could run 2 to 3 years. My credit was already taking damage that would compound monthly. And attorney fees for a fully litigated civil case could approach or exceed the value of the loan itself. Settling, absorbing the loss, and rebuilding over the following years was the rational financial calculation. I remember sitting in her office after that conversation and thinking through the math she had laid out. She was not wrong about any of it. The numbers supported the settlement argument. I almost made that call. There was a Thursday night, I remember it, because I had just finished a long final confirmation call with a client whose event was 2 days away, where I sat at my desk after she hung up, and I genuinely considered whether settling was the decision that made sense. Whether I was about to spend 2 years and $100,000 in legal fees to recover a reputation that a long public dispute might damage just as much as losing the original case. I did not make that call the next morning. What stopped me was not emotion. I want to be precise about this because it matters for what came next. I was not operating from anger at that point. The anger had been there in the first week. By Thursday night, it was gone, and what was left was something much quieter, something that felt less like fury and more like a calculation of my own. I had spent 9 years building an operation that ran on documentation, signed contracts, time-stamped approvals, email threads on every decision, vendor agreements with version histories. If he had been diverting money from the business for months before the loan, That diversion had happened inside systems I had built and controlled, which meant the trail existed somewhere. And I was not going to agree to anything until I had found every piece of it. So instead of calling the bank to discuss settlement terms, I sent a formal written request under the Fair Credit Reporting Act for the complete loan file, every page of documentation associated with the account, including all application materials, authorization records, and transaction logs. What came back changed everything. The bank sent 47 pages as a PDF. I read through the file page by page at my kitchen table over the course of one evening. The first 3 pages were standard, account summary, credit limit history, balance and payment timeline. Page 4 was the application activity log, a complete time-stamped record of every action taken on the account from initial submission through the most recent transaction date. The application had been submitted at 11:14 in the evening on a Wednesday night. I have a standing company policy that has been in our operating agreement since year 2. No vendor approvals, no contract authorizations, and no financial applications of any kind are submitted after 7 o'clock in the evening without my direct, written sign-off. The policy exists because I had learned early in the business that decisions made under deadline pressure at the end of a long day produced errors. I wanted everything material to go through me during business hours. That rule was not informal guidance. It was a clause in the partnership operating agreement. Every person with access to company systems had signed a document acknowledging it. He had not only signed that acknowledgement, he had been in the room when we wrote the language. The IP address associated with the 11:14 p.m. submission was in the application log on page 4 of the file. I wrote it down by hand on a notepad. Then I called our IT provider the following morning and requested 14 months of internal network access logs, the records they retain of every device that connects to the business network, the timestamps of those connections, and the IP addresses associated with each session. That IP address was in the logs. It was registered to a device he used regularly, not a company-issued machine, not a desktop at the office, a personal laptop, his own device that had connected to the business network repeatedly over the 14-month period, including on the night in question. A personal laptop, connecting through the business network, submitting a loan application in my name at 11:14 on a Wednesday evening while I was asleep. I forwarded page 4 of the bank file to my attorney that night with a message that said 3 words: "I am not settling." She called me the following morning and told me we needed to talk about something beyond the civil case. What she had recognized, and what I had not yet fully processed in legal terms, was that what he had done was not primarily a civil matter. It was a criminal one. Submitting a loan application using another person's identity and a forged signature to obtain funds from a federally insured financial institution is bank fraud under Title 18, Section 1344 of the United States Code. Transferring the proceeds of that fraud across financial accounts by wire implicates the federal wire fraud statute under Section 1343. Using my legal name, my company's federal tax identification number, and a forged reproduction of my signature without my authorization constitutes aggravated identity theft under Section 1028A. That charge carries a mandatory minimum sentence of 2 years that runs consecutively to any other term imposed. It does not run at the same time. It stacks on top. My attorney submitted a formal referral to the FBI's Financial Crimes Division and filed a complaint through the Internet Crime Complaint Center. The bank, now aware that a federal criminal investigation was opening, became substantially more cooperative than it had been in any of the previous conversations. Their internal fraud team pulled the complete wire transfer records for the 11-month account history. The 3 destination accounts that had received the $194,000 in outbound transfers were traced through standard correspondent bank records. The first account was registered in his legal name. The second and third were limited liability companies incorporated in our state within the previous 14 months, registered during the same period when those unexplained vendor invoices had begun appearing in our expense reports. Both LLCs listed him as the registered agent on state formation documents. He had opened those companies while we were still running weekly meetings. While I was still forwarding his logistics reports to our accountant, the bank froze all 3 accounts within 48 hours of the FBI referral. Over the following 6 weeks, federal investigators interviewed me twice. I provided everything I had. The IP log comparison laid out side by side. The access records from the IT provider. The operating agreement with the after-hours authorization clause, scanned copies of the original vendor approval records, and 14 months of internal email correspondence between the two of us, including 3 separate threads in which he had asked, in a context that had seemed routine at the time, about my travel schedule and when I expected to be out of the office. The documentation I had built to run a clean and accountable business became the documentation that built a federal criminal case. He was indicted on 7 counts, 2 counts of bank fraud, 1 count of wire fraud, 2 counts of aggravated identity theft, and 2 counts of money laundering connected to the transfers into the else accounts. Before the criminal trial, his legal team negotiated a civil consent judgment. The total figure was $412,000, covering the outstanding loan balance, the vendor funds diverted in the months before the loan, and my verified legal costs. The judgment was entered against his personal assets. He did not have $412,000 in accessible assets. He had spent most of it before the accounts were frozen. The criminal case concluded 14 months after the morning I opened that first late notice. He was sentenced to 6 years in federal prison. The aggravated identity theft counts added the mandatory 2-year consecutive term on top of the fraud sentence. The bank submitted documentation to the credit bureaus, formally removing all reporting associated with the account. The debt was cleared from my record entirely. People ask me sometimes what I would have done differently. I do not have a clean answer. The warning signs were visible earlier, the unexplained invoices, the questions about my schedule. The supplier relationships I had not fully reviewed. But I was running a full operation. I had a documented partnership built on a clear division of responsibilities. And 6 years of working beside someone creates a kind of assumed reliability that is very difficult to override on the basis of small discrepancies that each have a plausible explanation on their own. Careful people get betrayed. That is the thing. Being thorough and organized does not make you immune to this. It changes what happens after, but it does not prevent the moment of discovery. That moment still comes. I want to say that plainly because I spent a long time after this wondering what I had missed and whether I should have seen it sooner. The answer is maybe. But the more important question turned out to be what I did after I saw it. What I did was treat the records I had built to run my business as the tools I needed to fight back. Every time-stamped log, every signed agreement, every documented policy became a piece of evidence I already owned. I had not built those systems for this. But they were ready when I needed them. He had calculated that the cost of fighting him would exceed the value of fighting. He was right about the math. He was wrong about me. If something in your business does not add up right now, an invoice you do not recognize, a timeline that does not track, a signature on a document you do not remember seeing, start a folder tonight. You do not need proof to start a folder. The folder is how you find the proof. Mine did. 14 months late. But entirely on my own terms. When the FBI agent called to give me the final sentencing date, she mentioned the name of the forensic accounting firm that had traced the final wire transfer sequence through the LLC formation records. I had worked with that firm once before 3 years earlier, on a compliance audit for a long-term corporate client. When I read that firm's name in the case summary, I recognized the work.